Shorts in just about every market recently been caught with their hands in the cookie jar. But there are no free lunches. Today we are discovering new data out of the market that stems to GDP over next for the recent months. And we can find that US economy shrinks for a second quarter, raising recession odds. Today in Blockrevision, I'd like to get through this topic, and that's one of the things that I would like to ponder about with you, of what that may mean for market, for investors, and what are the next steps that Fed may take right after recent interest hike rates by 75 points. So today I invite you to watch another episode of our channel where you can find the most updated news about the stock market, indexes, about the commodities and cryptos. Everything in one place. So let's get into it. So in terms of recent GDP data on economic calendar, we may find that we already have crossed a negative level by second consecutive month. American economy shrank and annualized 0.9% on a quarter in quarter 2 2022. Residential investment sank 14%, structures 11.7%, and equipment 2.7%. At the same time, PC slowed and grew 1%, with spending on goods falling 4.4%, and government consumption went down as well. Right on Bloomberg, we may find that details of the report show decreases in business and government spending and residential investment. Inventories also weighted on GDP. So that's a report that already been published about the market, because that's very important what the market reaction is. We may find that market right now maybe not showing much of a reaction. It's still somewhere between let's get to US 100. It's somewhere between those 12,470 and 12,650 area. So we are right now at the 1 week high, and there might be a level of a return. I do expect that with this bad data we may get maybe a bit rise into a upwards in order to confuse investors, and right after we'll get not maybe further than 747, and right over we'll have a strong return. That's the natural reaction, as I do find that there is a very negative gauge of the economic calendar. So that's something that may get investors that took longs recently, made them caught with their hands in cookie jar, as I said in an intro. So that's something that is terrible. And it means we are closer and closer into a recession, officially acclaimed recession territory. There are many symptoms that already been pointed to that outcome, but this GDP is one of the biggest one. So we are getting back to the topics that I would like to just revolve around. That is economy view, and we had yesterday the Fed that decided to hike interest rates by 75 points to a range 2.25 25% to 2.5 in this area. So everything is in line with expectations. They find that another rate increase may be still appropriate, quoting them. So we can find that this recent reaction on the market that was kind of enthusiastic, right now might get punched, and we may get a pivotal moment on that. Fed has claimed that we are not in a recession territory by them, but what do they know? Alan Greenspan in 1973 told there's never been a better time to buy stocks, and this claim was just a few days before the market has slumped by 45%, and that's why we may find that Fed and the members of such institutions have no idea of literally have are not better, I would say, knowledgeable than the average investor. We are jumping next. We may find that overnight reverse repurchase has got over at $2 trillion, and I would like to point this in the chart to get my roots of thinking to the point that hiking interest rates in such territory might be troublesome. Despite having a very good, I would maybe say not very good, but a good labor market, maybe something that may prompt Fed to seek for maybe higher interest rates due to this very high inflation. Right now, it's something that maybe not sufficient. Fed's balance sheet reduction process is proceeding as planned, but it has come challenges because financial institutions are likely to start to compete more aggressively for deposits, and this may push short-term interest rates higher, including the effective Fed funds rate targeted by U.S. monetary policy. So that's why this reverse repurchase stand is important, as Fed could cut its overnight reverse repurchase facility where a shortage of treasury bills has caused daily balances to routinely exceed $2 trillion in the past 2 months. So right now, Fed is if they not cut this exactly reverse repurchase facility, that will outcome with the troubles in 2023. So that's the one thing we need to ponder. But Fed right now is showing us that the markets are expecting that Fed will become more dovish and dovish, especially with the problems with the economy as they are right now. I will not submit opinions that after a Fed press conference the Fed will deliver any dovish pivot. I would rather say that they still will keep the line, but that's something that may have some may make some cracks on the market. Very likely is that Fed funds rate over the remainder of this year could conceivably be higher, but it's something that may prompt us to think that still there's something more troublesome. There's a war in the air. There are COVID lockdowns in China. disrupted supply chains that the Fed has no, by any means, have an impact on, and that's why hiking interest rates right now, I would say it gets to not very good idea. So right now I would find that with this a very poor condition of economy, we need to stay cautious, because market tends to pivot in such moments, and that's why we need to hang on for a while in order to stabilize. I don't find the market to go down from here, as market needs to slow down their hiking and in order to contain those economic problems. So we can say literally that easy part of the rate hike cycle is behind us. Now the Fed will be in a real pitfall. Just look at house price indexes. This one is skyrocketing, but home sales is going downturn. So how we can really maintain the bubble still going on? There must be a slowdown. There must be a recession. There must be problems, because we cannot maintain such a pace of growth. The leitmotif is from Fed this: a slowdown is needed to contain inflation, and that's right, but a slowdown is already here. So Fed has been too late, and they cannot admit it. That's the main problem. Until a few months ago, companies reported deficiencies in almost everything. Right now, there was a problem with demand. Right now, this all is starting to be available, but suddenly demand is collapsing now. Business climate indicators already show a strong slowdown, in which the Fed needs to tighten in its policy further. That's a killing approach. So whenever there was a recession back in the previous months, previous years, Fed normally was quantitative easing rather than tightening. So that's the situation where we really may start thinking of really difficult times ahead. The market is counting on more and more dovish Fed and rate cuts next year, but the matter is not that simple. If we look only at economic activity, the Fed should postpone further increases. Now, activity slows down, demand slows down faster, and this faster with every moment. So we are right now in a very difficult situation, especially Mr. Powell makes some problems, as we've already told, looking at lagging indicators not leading. For instance, looking at non-farm payrolls is the lagging one. However, initial jobless claims is the leading, and that's the difference. Where back a few months ago, Fed made looking at not that indicators that supposed to watch. Looking at pending inversion right now, back in the first half of this year, Mr. Fed also claimed that he prefers to look at the short end of the yield curve as a recession indicator. So implied yield on 3-month T-bills in 18 months right now is showing that we are in a very steep slope, but we need to be ready that every single reaction, every single spook that may come from Fed's stance may lead to a steep hike. if the hike happen, that would mean that we are getting weaker economy on the way, and that would have a strict impact on interest rate cut. So right now Fed may not be cutting, but with this inversion, this pending inversion will, if happen, if the economy will get weakening, we may find that quantitative easing may yet to be delivered in not maybe this but next year. So if the market will interpret an aggressively hawkish tone anytime soon, or any other or rather very difficult environment that Fed will find out, their participants may test that tool, and an inversion may get possible. Looking ahead, we are in a really troublesome environment where after this GDP being published, there were no coincidences. I will find that there are real problems with these gauges already been pointing a real slowdown, such as consumer expectations, factory work week, building permits, as well with stock prices that also affect the economic condition. So right now we are in an environment where problems are getting harder, unfortunately. So in order to revive this bad data, we do need really a very good governing, and by now I don't expect this from Fed to happen. So it looks like the market just need to clear out from this bad outcomes, and unfortunately the time of bankruptcies of different companies' defaults may just be ahead. So we need to pay for this steamy checks, for this easy money being delivered to the market, and but it doesn't mean that quantitative easing won't happen again. I do find there is still a high probability of this one to get to the market. So weekly wages adjusted for inflation is also a problem. As we can find, we cannot keep up this inflation, and workers are not earning as much as they should. Inflation adjusted wages are growing slower than inflation. So right now we are getting at this around 2-year lows, and this trend is getting to make a reverse. So that's also something that is very, very worrisome. We are reverting even that curve. JP Morgan for Euro area is also forecasting a negative GDPs. So after this US gauges, there's nearly 100% certainty that that will be problematic. Also, some problems are coming from China. China is right now hurdles in terms of freedom. Many of it's not maybe very easy to get, but many of rich guys are trying to leave China due to draconian measures regarding the COVID-19. So China is a large manufacturer by large, and also has a quite chunk of share in global GDP. And therefore, all the world look at them. It's kind of a litmus paper, and if Fed control, we may assume if Fed controls the global finance, China and PBOC liquidity control tempo of a world economy. That's one of the citation I've recently heard, and that's kind of true. So right now in China there are lots of institutional barriers. You might have the desire to grow as a or develop yourself, but there are various hurdles. There is a Chinese government that is making the path for the development kind of a problematic, as there is many obstacles to on the way to thrive. Many entrepreneurs are claiming that there are more challenges down the road ahead of China in the coming years, even stemming to that problems that are the listings due to lack of auditing of some the companies. So that's why American stock exchanges are kind of preparing to delist some of Chinese stocks as Alibaba or JD. There will be a very hard nut to crack for those companies. Chinese liquidity and the world business activity, it right now showing that we may get a revert, and this hike interest rates may get lower. That is why I do find that with recession we may get a probably a, as we know, a bad data for the economy is in this environment a good stimmy for the stocks. So I do find that the market will revert at first as recession is over here, but in the long run I do find that the Fed will start to putting off their foot of the pedal and probably turning to lower interest rates during this year and probably next one. So this one, CEO confidence, that's also something that cannot be fixed by any measures, any tools that Fed is in possess. Also, we are struggling with famine problem that right now is gets to the war. That even if the war ended tomorrow, Ukraine's agricultural and port infrastructure need to be rebuilt, and the waters of its coastline demand. The country's farmers may not be able or willing to come back to work on their land. So we can find that this recession, this crisis will probably become a global one without any lands that will be untouched. It's undeniable that we are seeing lower yields and harvests over the past few years due to the growing impact of climate change. That's also something that bother many of farmers. So climate change is also showing, at least in this year, that we are just going through the heat waves around the planet. That's something that also doesn't bode well for the future. Driving demand lower, that's also something we already noted. So oil is getting lower. That's better for consumers and may release some better sentiment around. In terms of DBC, Commodity Tracking Invesco Index, we can find that we have formed possibly a top, but I would wait for a rebound to those levels of 27th, and therefore find out what the reaction of the market may be, because maybe we are after this very robust period on the market, but due to market demand, there might be still some appetite for some of the commodities. Right now, I do rather expect that commodities will have their dead cat bounce, but if the quantitative easing may get back to the Fed stable, there might be a fuel for these assets to get over. Getting to market outlook, we can find that S&P 500 around recently has have that tendency that tended to bottom about 4 months before the official recession end date, and that means, maybe I will just zoom out a bit, so we find that whenever the bottom, I would say at first that I don't know if we even have an official recession started yet, because this GDP, technically the second consecutive gauge of GDP in terms of negativity, is just one of the measure of being noted of a US recession, but we can find that there might be other measures that will be verified by economists responsible for acknowledging whether we are in that or this or that environment. So typically, after forming a bottom, we have at least around 4 months of recession yet to go through. If we already hit that bottom, as I don't think literally so, that the end might be somewhere around third and fourth quarter. But as I said, if the Fed will change their view on the crisis and the US situation where we are at, there might be steamy for the stocks to grow. So recently we've seen stocks rally right after 75 basis points again, but today there might be reaction to the downside. There's kind of a risky bet right now, because due to what market is telling, there is an appetite for getting through this resistance and heading to 13,000. But I would expect there might be kind of a rebound and reverse being observed next. So I would listen to what the market is telling us right now. There is very difficult to take any decision, whether it's upwards or downwards. I would just wait whether we cross through 13,000. If we manage, there will be a good point to start another position a bit higher. In terms of sentiment, there's a quick sentiment check. Fear and greed index is right now at 38 points. That means that we just got over this extreme fear, but we are still nowhere near the greed. What we had right there, the Morgan Stanley's telling there might be a very good time to bargain hunting for stocks. I would be quite skeptical to those voices, but I do find that that many of stocks may have a relief rally in August, at least in August. So US 100 is still maybe on the path to 13,300, but afterwards they will be very difficult to get it through, especially on that bad economic data. So recently, the S&P 500 earnings growth and price returns showing us that right now we are in an environment where the average year and PE ratio for the S&P 500 since 89th is 19.6. Right now we are around 4% below it, so it may mean that we may already getting it over, but we need justification this on the chart. So it may mean that stocks are fairly valued, but we still need to wait for what the earnings season may bring to us. So about the earnings, I will tell a few words a little bit later. There is a very low, as we find, customers and retail traders positioning. We are right now at the situation where taking higher than normal risk levels are right now lower than it was back in the trough of global financial crisis. So that's very, very something important that we may find a rebound, but afterwards I do expect this recession to last longer. In terms of crypto outlook, we can find that crypto is maybe suffering from price issues, but it's definitely something that is for hard times for different residents around the world. Whenever the local currency is devaluing and losing its purchase power, there is an obvious turn to something more stable, that is cryptocurrencies. Even with this recent slumps around 20-30%, 40% there's nothing with hyperinflation being seen in many countries around the globe. Crypto should get its own laws to aid ownership claims, UK says. So that's something that also is very I would say meaningful, because regulators are right now worrying about how to qualify those type of digital assets. There are many types of different propositions, but neither any of them is working out right now. Now we can also find that those regulations may take even a longer time than it's supposed to, and as we can find, there is still a long journey before the details are put into law. So we can find there is very different type asset class, and in relation to what been known, what been recognized on Wall Street. So that's something that we will wait for. I don't hope, so I hope that we won't wait for regulations by 2025 by that far. Hopefully that will be next, or the worst scenario 2024. For that, that will be also a very important year for crypto. That will be halving year. Right now, let's find out the stablecoins. Stablecoins are showing us all other indicator of what the sentiment around the crypto is right now. There might be a sign of a peaking on USDC plus USDT chart divided to total market cap. Right now, we've seen there are many stablecoins on the market waiting on the sideline, but unfortunately, there's something like a sell-off being made after this very strong June's reaction. So we had seen that this interest in stablecoins right now might be falling a bit even harder. So it doesn't mean that crypto market won't get up of this tough time. I do find that still we need some more time for this. So right here we can find that the token velocity of stablecoins is also dropping. So it means that even with the stablecoins sitting on the sideline, we don't find that there is many of a usage of them. So that means there are negativities around that assets. Tether, however, calming down the atmosphere that says that no Chinese commercial paper among its reverse is noted, as Bloomberg last year found evidence that Tether's reserves might include short-term loans to large Chinese companies, and that would mean problems for solvency of Tether if they will get into troubles. Recently, Chinese stocks have gone through some chaotic environment. Bitcoin cycle floor hardness, that's kind of a fun fact, I would say, or maybe a different type of showing you how things are really going. Right here, after this slump, we may find that hardness been a little bit stronger than it was back in 2019 and 2015, but it was kind of a very long period of time. So we may get kind of a bounces from this lower levels back on the way. So by large, cycle floor hardness tracks the correlation between the penetration rate and implied falls to map this bigger times of hardness. In terms of market movers, we have had on Wednesday data from Germany that been already discussed, Fed interest rate decision as well, pending home sales that turn out lower than forecasts by 11%. And on Thursday we had economic sentiment in euro area that also dropped. Inflation rate in Germany has hiked, and many of bad news are on our side. Initial jobless claims remained stable from US. We are awaiting on Friday GDP growth rate from France, inflation rate, and also GDP from euro area. But it looks like might get problematic to get over this positive territory. So get over this negative territory that's expected. In terms of earnings, yesterday we had Meta that earnings miss expectations, and net income plummets 36%, and Microsoft stock that shown kind of a good results regarding this criteria. So by and large, right now we may find that earnings season is not that bad as been expected. Many of growth stocks are keeping up the expectations, and the ones that are maybe getting a little bit slower are defensive stocks. So it means there might be a time for tech stocks to get a relief rally next weeks. Trade idea for today is natural gas that recently has risen by plenty percents. Europe energy prices keep soaring as Russia tightens supply, we may find on Bloomberg, but these are the news that already been known and priced in to the market. Natural gas hits highest level since 2008, on pace for best month ever as Russia cuts supply. These were the headlines. Also, the market is scared of cost of energy per month projected for the next half a year, but that's something that already been, I would say, well, a market has accustomed to. So by commitments of traders, you may find that recently the commercial has drawn its positions lower right after this hike been formed. We may find that commercial has grown their position right here, but right now keeping the stable. But the one thing that are growing, that are right now trying to catch this wave, are non-commercials, other reportables, and also the small market players that are joining this market. So that means there might be a kind of a relief rally downside with new money being caught right here. And in terms of chart, I would like to check that out with you. So right now on natural gas futures, we have just built a biggest correction in this trend since beginning of July. So that would mean that we are more likely to get downwards than to get upwards. Right now, the biggest resistance is this highest point on 9.7, but the support is 8.2. Whenever natural gas will just get closer to 9, I do find there is a good chance to get a short position. Especially there might be equalized. This natural gas may get equalized to these levels at 9 points, and there might be a very good chance to take a short position. In terms of trading board, there will be a short. So if we got right around this area, I would find there will be a good risk-reward ratio for the trade at 2.14. It's not maybe the highest, but still quite kind of favorable, and there is something that I ponder about. If you'd like to hold natural gas even longer, there is obviously a chance to get natural gas to recent lows, even down to 5.58 points. So remember, if we won't get this blue box of where I do find the possibility to get an entrance, I wouldn't find this trade proposition as valid. So right now, natural gas is the one of the candidate for the short, but it need to reach these levels. So that's it in today's episode. Thank you very much for watching. If you have any questions, just put it in the comment section below the video. And if you enjoyed our content, just give a subscribe button. So we'll see each other tomorrow. Have a good investments and take care.